Money. For centuries, it has flowed through the hands of merchants, the vaults of temples, and the marble halls of banks. But today it flows through circuits, algorithms, and digital networks that span the globe in milliseconds. What if I told you that the institution that has guarded your money, financed empires, and shaped our modern world for over 500 years is facing extinction? The bank, that towering pillar of economic power, may soon become as obsolete as the gold coins once stored in its vaults. We stand at the precipice of the greatest transformation in financial history since the Medici family pioneered modern banking in Renaissance Italy, a revolution where code replaces clerks, where trust is built not on human relationships but on mathematical certainty, and where financial power shifts from institutions to individuals. This is not a story of incremental change. This is a seismic shift that will redistribute wealth, redefine power, and reimagine our relationship with money itself. Some call it progress, others call it disruption, but everyone agrees there's no going back. Join us as we explore the twilight of traditional banking and the dawn of a new digital economy. The question isn't whether this transformation will happen. It's already underway. The question is, are you ready for a world without banks? The end of banks, the rise of the digital economy. The story of banking begins not with gleaming skyscrapers, but with ancient temples. Around 2000 BCE in the fertile lands of Mesopotamia, the first prototype banks emerged. Temples became the safest places to store grain and precious metals, with priests serving as the world's first bankers. These early financial centers did more than just store wealth. Historical records from Greece, Rome, Egypt, and Babylon reveal that temples also issued loans, charging interest much as modern banks do today. When armies conquered cities, they inevitably ransacked these temples, the world's first bank robberies. It was the Romans who formalized banking, moving it from temples to dedicated buildings. Julius Caesar revolutionized lending by allowing bankers to confiscate land when loans weren't repaid, a monumental shift in the relationship between creditors and debtors. For the first time, even landed nobility could lose their estates to debt. After Rome fell, banking retreated into the shadows. The Catholic Church condemned usury, lending at interest, as sinful. Yet financial services remained essential. The Knights Templar and papal bankers found ways to navigate these restrictions, keeping the flame of banking alive through Europe's dark ages. The true foundations of modern banking emerged in Renaissance Italy. In the affluent cities of Florence, Venice, and Genoa, powerful families like the Bardi, Peruzzi, and most famously the Medici, transformed banking into a sophisticated system. When Giovanni Medici established the Medici Bank in 1397, he created an institution that would finance art, architecture, and eventually, the European Renaissance itself. The oldest bank still operating today, Banca Monte dei Paschi di Siena in Italy, opened its doors in 1472, 20 years before Columbus sailed to America. Think about that. A financial institution that predates the discovery of the New World continues to serve customers in our digital age. As banking spread northward through Europe, innovations followed. The Dutch Republic pioneered central banking and stock exchanges in the 17th century. In 1694, the Bank of England was established, creating a model that would be replicated around the world. For the first time, banks began issuing paper notes backed by gold, the precursor to modern currency. In America, banking's early days were chaotic. Without a single currency, banks issued their own notes. If a bank failed, which happened frequently, its currency became worthless overnight. After several financial panics, the Federal Reserve System was established in 1913, creating America's central bank and bringing stability to a fragmented system. The Great Depression revealed banking's vulnerability. As panic spread in 1929, Desperate customers lined up to withdraw their savings, causing even healthy banks to collapse. This led to the creation of deposit insurance and stricter regulation, safeguards that have largely protected traditional banking for nearly a century. The latter half of the 20th century saw banking transform through technology. ATMs appeared in the 1960s, credit cards gained widespread adoption in the 1970s, and by the 1990s, online banking began its ascent. Each innovation made banking more convenient, but preserved its fundamental structure. Centralized institutions that hold our money, facilitate payments, extend credit, and earn profits from the difference between what they pay depositors and what they charge borrowers. Then came 2008. The global financial crisis shook faith in traditional banking to its core. As venerable institutions like Lehman Brothers collapsed and governments scrambled to bail out banks deemed too big to fail, a fundamental question emerged. Had the guardians of our financial system become its greatest liability? It was no coincidence that in October 2008, as the financial crisis raged, an anonymous figure using the pseudonym Satoshi Nakamoto published a 9-page paper titled Bitcoin, a peer-to-peer electronic cash system. The timing couldn't have been more symbolic. As traditional banking faltered, the seeds of its potential replacement were being planted. In the aftermath of the 2008 financial crisis, as trust in traditional banking institutions crumbled, a revolutionary idea emerged from the digital shadows. Bitcoin, the world's first cryptocurrency, offered something radical. A financial system without banks, without central authorities, without single points of failure. Bitcoin's creator, the pseudonymous Satoshi Nakamoto, envisioned a system where trust wasn't placed in institutions, but in mathematics and cryptography. The blockchain, a distributed ledger technology that records all transactions across a network of computers, eliminated the need for a trusted third party. For the first time in history, people could transfer value directly to one another without an intermediary. What began as an experiment among cryptography enthusiasts has grown into a trillion-dollar asset class. Bitcoin's meteoric rise, from being worth pennies in 2009 to reaching over $60,000 at its peak, captured the world's imagination. But more importantly, it proved that digital currencies could work at scale. Bitcoin's success spawned thousands of alternative cryptocurrencies, each with different features and purposes. Ethereum introduced smart contracts, self-executing agreements with the terms written directly into code. Stablecoins pegged their value to traditional currencies, addressing the volatility that plagued early cryptocurrencies. Privacy coins like Monero focused on anonymous transactions. A new financial ecosystem was being built block by block. Adoption has been particularly strong in countries with historically weak currencies or limited banking infrastructure. In Venezuela, where hyperinflation devastated the national currency, many turned to Bitcoin as a store of value. In Kenya and other parts of Africa, mobile money systems have evolved to incorporate cryptocurrency features. In 2021, El Salvador made history by becoming the first country to adopt Bitcoin as legal tender. The rise of cryptocurrencies hasn't gone unnoticed by the very institutions they were designed to circumvent. Central banks around the world are now racing to develop their own digital currencies, CBDCs. Unlike decentralized cryptocurrencies, these are issued and controlled by governments, combining the efficiency of digital money with the stability and backing of traditional currency. China has taken the lead in this space with its digital yuan, already being tested across multiple cities. As of 2025, over 130 countries are exploring CBDCs, representing 98% of global GDP. This marks a dramatic shift from just 5 years earlier, when only 35 countries were considering such projects. The appeal is clear. Digital currencies offer near instantaneous settlement, dramatically lower transaction costs, and potential 24/7 operation. A stark contrast to traditional banking systems that often rely on business hours and can take days to clear international transfers. For the 1.7 billion adults worldwide without access to banking services, digital currencies offer a potential on-ramp to the global economy using just a smartphone. Consider remittances, money sent by migrant workers to families back home. Traditional services charge fees averaging 7% of the transaction value. The World Bank estimates that reducing these fees to just 2% could boost remittances to low-income countries by $16 billion annually. Digital currencies make this possible, allowing value to flow as freely as information across borders. The rise of digital currencies is fundamentally changing our relationship with money. Physical cash, the tangible bills and coins that have defined our concept of money for centuries, is rapidly giving way to digital alternatives. In Sweden, cash transactions have fallen to less than 10% of all payments. China's mobile payment systems process over $50 trillion annually, more than Visa and MasterCard combined worldwide. For traditional banks, this shift represents an existential challenge. Their role as intermediaries, the very foundation of their business model, is being questioned. As digital currencies gain adoption, the monopoly banks have held over the movement of money is eroding. The question is no longer whether digital currencies will transform finance, but how quickly and how completely. While cryptocurrencies captured headlines, a quieter but equally profound revolution has been transforming the broader financial landscape. Fintech, financial technology, is reimagining every aspect of banking, from how we pay for coffee to how global corporations manage billions in assets. Traditional banks evolved over centuries, accumulating legacy systems, physical infrastructure, and regulatory compliance frameworks that make innovation slow and costly. Fintech startups, unburdened by this history, have been able to target specific financial services and reimagine them from the ground up. The results have been remarkable. In China, Alipay and WeChat Pay have created a nearly cashless society where even street vendors accept digital payments. In Africa, M-Pesa has brought basic financial services to millions without traditional bank accounts. In the West, companies like Square, Venmo, and Revolut have made sending money as easy as sending a text message. At the heart of many fintech innovations lies blockchain technology, the distributed ledger system that powers cryptocurrencies but has applications far beyond them. Blockchain offers something revolutionary, a way to establish trust between parties who don't know or trust each other without requiring a central authority. Smart contracts, self-executing agreements with the terms written directly into code, are automating processes that once required teams of lawyers, bankers, and administrators. When predefined conditions are met, these contracts automatically execute, transferring assets, releasing payments, or updating records without human intervention. This has given rise to an entirely new financial ecosystem known as DeFi, decentralized finance. DeFi platforms offer traditional financial services like lending, borrowing, and trading, but without traditional financial institutions. Instead, they operate through smart contracts on blockchain networks, primarily Ethereum. Consider lending. In traditional banking, getting a loan involves credit checks, paperwork, and human approval, a process that can take days or weeks and excludes many people entirely. In DeFi, loans can be issued instantly to anyone with sufficient collateral, regardless of their credit history or location. The terms are enforced by code, not contracts. International payments reveal another stark contrast. Traditional bank transfers across borders typically take 3 to 5 business days and incur fees of 3 to 7%. Blockchain-based systems can settle these transactions in seconds or minutes at a fraction of the cost. For businesses operating globally, this efficiency represents not just convenience but competitive advantage. Perhaps most significantly, fintech and blockchain are extending financial services to the 1.7 billion adults worldwide who lack access to traditional banking. With smartphone adoption outpacing bank account ownership in many developing regions, mobile-first financial services are creating pathways to economic participation that simply didn't exist before. Traditional banks haven't stood still in the face of this disruption. Many have invested heavily in their own digital transformation, partnering with or acquiring fintech startups and exploring blockchain applications. J.P. Morgan Chase, once dismissive of cryptocurrencies, now offers its own digital coin for institutional payments. Goldman Sachs, the epitome of traditional investment banking, has embraced algorithmic trading and digital wealth management. Yet the pressure on traditional banking models is undeniable. In the United States alone, bank branches have been closing at a rate of over 1,500 per year. Banking jobs that once required human judgment, from loan approvals to investment advice, are increasingly automated. The very definition of what constitutes a bank is being rewritten. We're also witnessing the emergence of embedded finance, financial services integrated directly into non-financial products and platforms. When you buy now and pay later on an e-commerce site, or insure a purchase with a single click, or invest spare change from your purchases, you're experiencing banking functions without a bank. Meanwhile, tech giants like Apple, Google, and Amazon are leveraging their massive user bases and technological prowess to enter financial services. Apple Pay processes more transactions than many major banks. Amazon extends billions in loans to merchants on its platform. These companies don't need banking licenses to deliver banking-like services to their customers. Regulators around the world are racing to keep pace with these innovations, creating regulatory sandboxes where new financial technologies can be tested under supervision. The challenge is formidable: how to foster innovation while protecting consumers and maintaining financial stability. The regulations that governed banking for decades were not designed for algorithms, smart contracts, and digital assets. What makes this transformation so profound is its speed. Traditional banking evolved over centuries. The fintech revolution is unfolding in years. Blockchain technology didn't exist before 2008. Today, it's processing trillions of dollars in transactions and supporting a global ecosystem of financial applications that operate 24/7 across borders with minimal human intervention. As we venture toward a future where traditional banks play a diminished role, or perhaps no role at all, we face both extraordinary promise and profound peril. The financial system that emerges from this transformation will shape not just how we manage money, but the very structure of our economies and societies. Let's begin with the opportunities. Financial inclusion stands as perhaps the most compelling promise of a digitized, decentralized financial system. Today, 1.7 billion adults worldwide lack access to basic banking services. For them, saving money securely, obtaining credit, or sending payments often involves high fees, physical risk, or complete exclusion. Digital financial services require only a smartphone and internet connection, infrastructure that's expanding faster than traditional banking ever could. In regions of Africa, Latin America, and Southeast Asia, people who never had a bank account are now participating in sophisticated financial activities through their phones. This isn't just convenience, it's economic empowerment on an unprecedented scale. Efficiency represents another transformative opportunity. Traditional banking systems are laden with friction: paperwork, processing times, intermediaries, and fees. Digital alternatives can reduce transaction cost by 90% or more, while increasing speed dramatically. For global commerce, remittances, and everyday payments, these efficiencies translate into trillions of dollars in economic value. Innovation flourishes in open systems. The decentralized nature of many new financial technologies has created space for experimentation that would be impossible within traditional banking's regulatory and structural constraints. We're seeing new models for lending, insurance, investment, and payment that serve needs traditional banks overlooked or couldn't address profitably. Transparency offers another potential benefit. Blockchain systems record transactions on public ledgers, creating unprecedented visibility into financial flows. While privacy features can protect individual identities, the overall system can be more transparent than traditional banking, potentially reducing corruption, tax evasion, and illicit finance. Perhaps most profoundly, these technologies promise greater financial autonomy. In a world where individuals can custody their own assets, execute transactions without intermediaries, and access global markets directly, the power dynamics of finance fundamentally shift. No longer must we entrust our financial lives entirely to institutions that may not always act in our best interests. But this future is not without significant risks. Security concerns loom large. While blockchain technology itself has proven remarkably resilient, the interfaces where humans interact with these systems, exchanges, wallets, apps, have suffered numerous breaches. Over $10 billion in cryptocurrency has been stolen since 2017. Without the consumer protections of traditional banking, these losses are often permanent. Volatility presents another challenge. The value of many cryptocurrencies fluctuates wildly. Bitcoin has seen multiple 80% drawdowns throughout its history. While stablecoins attempt to address this issue, they introduce their own risks, as demonstrated when several lost their pegs during market turbulence in 2022. For money to function effectively as a medium of exchange and store of value, Stability is essential. Environmental concerns have also emerged, particularly around proof-of-work blockchains like Bitcoin, which consume significant energy. While proponents argue this energy secures the network and increasingly comes from renewable sources, the carbon footprint remains substantial. Newer consensus mechanisms like proof-of-stake dramatically reduce energy requirements, but adoption varies across networks. Regulatory uncertainty casts a shadow over the entire space. Governments worldwide are struggling to develop frameworks for digital assets that balance innovation with consumer protection, financial stability, and law enforcement needs. This uncertainty creates risks for both users and businesses building in the space. Perhaps most concerning is the risk of creating new forms of financial exclusion, even as we solve for old ones. Digital literacy, internet access, and technological resources are not evenly distributed. Without careful design and policy, a financial system built on advanced technology could exacerbate rather than reduce inequality. There's also the risk of recentralization. While blockchain technology is inherently decentralized, economic forces tend toward concentration. We already see this in mining power, exchange dominance, and development influence. If these new financial systems simply replace traditional banks with new centralized powers, tech giants, large exchanges, or dominant protocols, have we truly transformed finance or merely changed its appearance? It's worth noting that traditional banks are not passive observers in this transformation. Many are adapting, incorporating blockchain technology, partnering with fintech companies, and reimagining their business models. The future may not be bankless so much as bank different, with traditional institutions evolving rather than disappearing entirely. Indeed, the most likely outcome may be hybrid systems that combine elements of traditional and decentralized finance. Central bank digital currencies represent one such hybrid, government-backed money in digital form, potentially offering the stability of traditional currency with the efficiency of digital systems. What's clear is that we stand at a pivotal moment in financial history. The decisions made by developers, businesses, policymakers, and individuals in the coming years will shape not just how we bank, but how economic value flows through society. The end of banking as we've known it doesn't necessarily mean the end of all that banks have provided: security, stability, credit, and financial infrastructure. Rather, it means reimagining how these functions are delivered in a digital age. As we stand at this crossroads of financial history, the transformation is undeniable. The institutions that have dominated our economic landscape for centuries are being reimagined before our eyes. But perhaps the end of banks as we know them isn't truly an ending at all. Perhaps it's simply the next evolution in humanity's eternal quest to create systems of value and trust. From shells to gold, from paper to plastic, and now from plastic to pixels, money has always been a story we collectively agree to believe in. The difference now is that we're writing this story together, across networks that span the globe, using languages of mathematics and code that transcend national boundaries. The question that remains isn't whether traditional banking will survive, it's what we will build in its place. Will this new financial architecture truly democratize wealth? Will it include those who have been excluded? Or will it simply create new gatekeepers, new powers, new inequalities? There's an ancient proverb that says, "When the winds of change blow, some build walls while others build windmills." As the digital winds transform our financial landscape, each of us faces this choice. The end of banking as we know it isn't just about technology. It's about reimagining the very foundations of trust, value, and exchange that underpin human civilization. And in that reimagining lies both tremendous peril and extraordinary promise. The future of money is being written right now in lines of code, in government policies, in business decisions, and in the choices we all make. The only question is whose signature will be on that future.